typical.
Well, we're glad to have you with us. Hi, everyone. Thanks for joining us as people continue to hop on here. This is the last week in Mortgage Today. And today we have, and I'm Faith Howard Mooney from TMC, not Rich. I have with me today Jodi Hall, who is the president of Nationwide Mortgage Bankers. Thanks for doing this with us today, Jodi.
For sure. I look forward to your best Rich Swerbinsky impersonation.
I don't know if I have one, although he and I tend to think quite similarly. We finally let him, after our conference was over, which we'll talk about in a few minutes, we actually let him have some respite and go on a vacation with his family. He is due back with us tomorrow. So we're kind of excited to see what stories he has to share. From staying down in Florida for a while, but yeah. So let's just kind of hop in to the conversation. We obviously appreciate the fact that you would come to Miami and be with us at our conference. So it's so nice to be able to see you in person this last week. There were just so many things that I think are so relevant to the industry that were talked about when we were there. And of course, one of the ones that seems to, kind of happen right out of the gate always is the interest rate environment that we're in, and that it's rising. And one of the things that kind of stem from that we heard about in a number of sessions is diversification of products in the industry. I heard the word ARM, not meaning this arm, but the other type of ARM for the first time in a long time. So we'd love to just kind of get your take on, what you heard and what you took away from that. And then, of course, also what Nationwide is doing. And if anybody who's on the call wants to hop in to the chat and share with us what you're doing related to product, we would love to hear that too.
Yes, definitely. I think that for a number of reasons, we have to cast bigger nets, whether you're out marketing and trying to find buyers who actually can find homes. That is a novel concept. We have so many borrowers that are qualified in a pipeline and they can't find a property. But hearing a lot about ARMs, we haven't been an organization that has done ARMs in the past. There's a all-in-one interest only that was brought to us some time ago that we looked into, and I'm like, guys, we have to have another outlet. You can't just have, well, now everyone's like looking at all-in-ones. But also there's a big push to HELOCs. We added some HELOC lenders just that we could refer business to, so that we can break down that mortgage so that they're, can avoid PMI on the first mortgage, add the HELOC on. Borrowers need cash. So if they have cash and they want to do home improvements, potentially having them save that cash, do a HELOC that they can later pay off. Or not hearing a lot about second mortgages, but much more about the HELOC option. Yeah. Also heard a lot from a product perspective of working with different investors who are trying to meet their CRA requirements and trying to find products that we can serve lower served communities and low income areas, which is very difficult. We're really which we knew that it would go this way, right? So we have historically high home values. We have interest rates on the rise and low inventory in affordable housing. And we're supposed to lend to borrowers that are below market income. And it really is like the perfect storm. And there's a lot of talk and really like shaking your head and like, how do we get, how do you get someone who is below the median income? How do you get them winning bids so that they can get houses? And in the areas that they're in, a lot of times they're being swept up by investors because rental rates at historically high levels. So it's very difficult to be in the mortgage industry right now. I told everyone it was really easy to look good in 2020 and 2021. Show me what you got now, because it isn't easy.
Yeah, it's definitely not the same ball game. And that's kind of a hard puzzle to put together if something doesn't change. And whether
Right.
that's the Rich Swerbinsky plan of, investors gaining something for selling
Yep.
all of the homes they own, or somehow giving them some sort of, tax credit incentive. I still think that's a good idea.
Yeah.
It's probably become more relevant now even than when we
Right.
started talking about it almost a year ago,
Yep.
because it's so hard for people just to get into a home or even find one. Here, I'm in the Twin Cities today, and you're in New York. You can't buy a house for anything under 3 here.
Yep.
I mean, everything, even, older homes in the city, you're talking 4s, 5s, 6s at a minimum. And
Right.
so it is kind of a hard puzzle to solve if something in that equation doesn't change.
Yeah.
Um,
Non-QM is another product. We were heavy into non-QM prior to the pandemic, and all the non-QM investors backed out. So we saw an opportunity going into the new year to increase our non-QM again, because it appeared as though the investors had an appetite for non-QM, and we even worked with Wall Street investors to sell to them. And now we have non-delegated investors that we have loans locked with, and they're like, we're not buying it. It's like, whoa, 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 like, wait a second. So it really is like, even as you're looking at additional products to be able to hopefully better serve your referral clients and to get business in the door, but the game is changing every day. And
yeah.
it definitely is, it's definitely a moving target. So you have to focus on, what you can control, like can't control, what investors are going to do and how shaky they're going to be. We can't control housing inventory, although I'd like to think that we could incentivize builders so that they're, building $300,000 homes as opposed to $600,000 homes, so that we can get more people into homes. But and then there's no land. So then what do you do? So I think that we have to control what we can control, and a lot of the talk is controlling expenses.
Yeah. Yeah. That was something that was talked about quite a bit. As a matter of fact, we had a session. We're going to have it again when we're in Chicago in September. That was the $100,000 hour. How do you ways to save money that maybe you as a company haven't thought about? So for those of you that weren't in Miami, please
Mhm.
join us in Chicago and join that session. I think there were some really, really good ideas in there of things that people hadn't thought of. And one of the things that was mentioned that we were sitting together during that session, I think I leaned over and said, I know this is going to come up in our company even going forward, because I saw Rich lean over and write something down. And that was asking your employees for great ideas that they have. They're the ones that are on the front line.
Mhm.
How do you trim some things in their world that maybe you wouldn't see, that they see every day? So Stacy just popped in here and said there were 20 plus ideas just from that session. Yeah, different things that you could do. Thanks, Stacy. Related to cost savings. And I know you've always been really great at that. Anything new, unique that you've had on your plate that you guys are looking at related to how do you make things work in an environment that's very different?
Yeah. So one of the things that came out of that session, and I think there were like 3 different people that said how they monitor it differently. And, it's the theory of you sign every check going out.
Mhm.
And once a year. And I'm like, whoa, whoa, whoa. Like, if you're doing that once a year and you're waiting until the end of the year, you're screwed this year. Like, you're behind the 8 ball. But I do something that we started doing. I mean, again, like, this isn't a surprise, right? Like, we knew in 2020 that, I mean, everyone was saying that 2021 was going to be a terrible year. And then we're in 2021 and we're like going into 2022 and there's no housing inventory and we have supply chain issues and everything else. Like, you knew we were going to end up here. So I think that you have to do it on a weekly basis, honestly. So every week, and this has been since I started here, I'm in accounts payable every week. I'm seeing the money that's going out, but mid last year, we started renegotiating contracts. One of our biggest was renegotiating warehouse contracts. And I know coming out of the meeting last week. We talked about it significantly. So sorry, warehouse banks, if you're all getting hit up. But, you know, we saw that as an opportunity to take a big bite out of what expenses are. But we've gone back through all contracts. So I just signed an updated contract with our QC vendor with a 12% reduction in post-closing QC, 20% reduction in the EPDs and decline reviews. And, you know, it's the conversation, and we've talked about this before, and kind of my theory on vendors. Like, I don't want to work with people I don't want to work with, right? Like it's kind of like 20 plus years in the business. Kind of feel like I have earned to work with people that I want to work with. So when we are vetting vendors, we're looking for people who fit into our culture. When you do that, it's a much easier conversation when you say, hey, listen, you know, production's down 30%, or, you know, margins in the industry are down 60%. All of those numbers, you say, listen, you know, we didn't say anything in 2020, 2021. We were doing really well. Now we're feeling a little bit of a stress. And when you're renegotiating those contracts, it makes a much better conversation, an easier conversation when you've developed a relationship with your third-party vendors. So when you're going back and having those conversations, it's like it's give and take, and it's a relationship business. And that's also, it's not just with your clients, it's you as the client should have those relationships. So we've been going back and negotiating every contract, and even when they say enough, that's it, I still ask for more, right? Like the worst you can be told is no. And it's like, well, there's someone else out there that can do what you do. And I can go find it. So, you know, so definitely negotiating contracts, the sign every check kind of theory. So you have your finger on where the money is going. Check your seat counts. This was something I learned the hard way. So like Optimal Blue, you're handing out, you know, you're recruiting, you're handing out usernames and passwords so recruits can look at pricing. You're doing all these things. And well, if you lose sight of that, you have a seat count. When you go over it, you start paying X number of dollars. It's happened to me a number of times before with a CRM, I always have been a freak about Encompass seats because I never want to have more seats than I fund loans, even though you're like, that can never happen. It can happen, and it will. Same thing with Optimal Blue, and just anything that has a seat count, make sure that those seats are being used. And if they're not being used, then take it back. And even if you're passing that cost onto the branch, do it for your branches. It makes them sticky. It helps you build relationships that you're looking out for them and in their best interest. So get them out of the way of themselves. Move to soft pull credit. We do a 2-bureau softball. That way you're paying a reduced cost from then paying for the full credit reports, because let's face it, credit report fees keep going up and up and up and up. It's being passed on to the consumer, except for those ones that don't close in our case. So if you do a 2-bureau pull, at least you're weeding out who you can't do business with. So you're not increasing that. And the other thing, and this is, I can't believe I didn't think of this, and I forget who even brought it up, is once you have bid out your loans and take your top investor and ask for 2 to 6 basis points more. Yeah. And even if they say yes, 50% of the time, which was like the amount that was thrown out there, that's real money that you have pickup on the sale of loan. So that was a great one. So whoever said it, I didn't say it. I'm not taking credit for it, but it was an amazing idea. And thank you for that. Because guess what? Our poor caps market people, I'm like, did you ask? Did you ask?
Of course they did, because they knew you were going to ask. For sure. Yeah. And Laura Schmidt, who's on with us today, said their internal audit department is currently running an audit to look at subscriptions to things and usage to identify costs. One of the things I think that people always forget about, and I think everybody's kind of guilty of it, when you get so busy and you're adding a lot of staff, you also forget when you lose those staff, to
Yep.
eliminate them from your seats. I
Yep.
mean, of
Yep.
things. It's like, are there people on your list that don't work for you anymore, or, move to a different role that they don't need that current seat in that application?
Yep.
That type of thing. I think it's always good to try to stay abreast of that. It's probably more important now than ever before. But
Yeah, absolutely. Which brings me to one that we also talked about, and has always been my passion, is introducing technology to do things more efficiently. And it doesn't even have to be about buying a software, right? Like
yeah.
if you can just, we were talking with our operations managers yesterday morning, and they have been making an effort to double check files before they go into underwriting and make sure that the files are just clean. And we're seeing that the underwriters are able to get through more just through that process and pushing files back. So if you take a look at like every step of your process, and if you can just like clean, if every day you can just get a tiny bit better, if you just have a tiny bit more quality, higher quality being passed to the next person, that's going to turn into days. And those days are going to turn into higher production by your underwriters. It's going to turn into reduced cost. It's going to turn into reduced errors where you have post-closing issues on the back end of the process. And I also think educating each of the departments on what the other department does and why it's so important that they do that and take care of it up front, so it doesn't turn into, like, for example, you need to check and make sure that the FICO in the Encompass matches AUS, matches the credit report, so that you don't think that you have a loan locked at a 770 and you find out you have a 683, and then you're finding that out in the back end of the process, and then you're having to try to unwind it. You can't unwind it, and then you're creating cost for your loan officers. So I think having those conversations and educating people too goes a long ways, and knowing what the impact of them not doing something is downstream.
Yeah, and it's all about time. Time is money. The more that you can get out of your staff. I know we've started to implement some, just like all of you are looking at how your staff is utilized and what they're doing. We're implementing some things here even that we implemented one easy thing. It saved us 4.5 hours a month. And, 4.5 hours isn't a big amount of time, but we're also a relatively small team. But 4.5 hours is 4.5 hours our member benefits advocates can, have with their clients and learn more about your business so that we can help you more. It's about maximizing what they're working on, and they're working at the highest and best use versus some of the things that, they don't really need to have their hands on. So
For sure.
yeah.
Lots of low hanging fruit. Check your purchase advice reconciliation process. We went through and used actually a tool that we already had, but we went through that process where someone would go into Encompass and enter all of the purchase advice information on a daily basis. And no, this is not a plug for Jonathan Freed's purchase advice OCR technology, but we took that and we went to the investors. We tried to get it into an Excel spreadsheet. So some of our investors, we get the file, and other ones we get the physical ones, but we type it into a template, and we use the Kinsey May batch upload tool where we update fields. So we use that batch update tool. So it took a person who did that full time to about 2 hours a day. So that's real time. Then that person can spend more time on the lock desk and helping provide a higher level of customer service and really comfort to the loan officers as they're locking loans.
For everyone who joined recently, this is the last week in Mortgage Today with Faith Howard Mooney, and we've got with us Jodi Hall from Nationwide Lending today. One of the things that also came out of our conversations down in Miami was some different programs that people are looking at related primarily to new construction lending, lock and shop programs, 12-month locks, and people are trying to be creative with what they're doing related to interest rates rising and longer time to get into a house. Share any experiences that you've had with those types of programs.
So someone told me we do a underwritten pre-approval. So the client gets their credit, income, and assets underwritten. I heard of a lender that has taken that to also locking. And in the Cleveland market, there's a local bank that does lock and shop, where they do the same they do the same credit underwrite with a TBD property, and then they lock it. It scares me to death, you know.
I
I
think it does
mean,
people.
well, and it's like, well, how long are you doing the lock? And they said 90 days. I have borrowers in our pipeline that have gone through our buy now underwritten pre-approval that have been sitting 120, 180 days. Like, I mean, and it's not just like one-offs. There's a lot. It could be, you know, partially because of the geography that we lend in. But I just, you know, I have a real fear for those long-term locks. We don't do construction loans. So if we were to have an investor who wanted to do a non-delegated for you know, however long, one-time close, or however long they want to do the locks on the loans, and I think that it's something that we are looking into, but not something that I want to take the risk from being an IMB. And having those long-term locks, because I mean, half our locks today are underwater on 30-day locks and 45-day locks. I can't imagine going even further out. I definitely would lose a lot more sleep than I already do.
Yeah. Yeah. I think that there's further things to be investigated there. I'm sure that we have some of our banking entities that have the ability to portfolio, you know, working in maybe more of that arena. One of the things we also talked, it came up quite often there, and, you know, I'm not an experienced person in the condo market, but we heard a lot about condo related issues when we were in Miami, specifically related to the new requirements that are out there. So just wanted to give a heads up to everybody on the call that has condo questions. We have set a date on 4/6, I believe at, it's either at 3 or 4 p.m. Eastern Standard Time. I get my Eastern and my Central mixed up depending on where I'm at, to just get together and talk about what all of those issues are related to condos and the challenges that you're having. Jodi and I were talking prior to hopping on the call here, and in the past, some of the fees associated with those condo docs and everything, we've heard a lot from people that because of the fact that they're having a hard time getting info, it's at 3 p.m. Eastern. Thank you, Angie Scarfino, on April 6th. People were waiving those fees for their borrowers, and their borrowers weren't paying them. But in the environment that we're in right now, you know, it's like, it's a big cut into your margins. And I think that, you know, we need to get together and try to find some maybe better solutions or ideas on ways that that will work better for people, rather than waiving those fees and not charging them. So let's talk a little bit about an even happier topic, audits. Heard from a lot of people that not only were their audits increasing, I was amazed at how many audits people were being hit with kind of all at once, but kind of an uptick in findings. So can you share any insight that you have as a lender on kind of what's going on in that environment?
So I don't want to talk about audits and the lack that we have had, because then I feel like that someone's going to come knocking, but I'm knocking on wood. Not audits. We went through just the FHA standard review. No one wants to use the audit word. And this was, I think we're fortunate because it was the beginning of last year. And I don't think I would want to go through that right now, because I feel like anybody's finding any reason to send you a repurchase demand or indemnification. So where we have seen the greatest increase has been with Freddie. And, you know, we've been extremely fortunate in being able to fight them. But when you talk about efficiency, it's just a waste of time. You know, Freddie sent us a repurchase request. It's been about 3 weeks ago. And I I hope no one's within earshot because they don't want to hear about this loan another time because I lost my mind. So we had a borrower who had consolidated debt and was like at 41% debt ratio. Loan goes to Freddie. Freddie comes back and says, hey, we don't like the way that you calculated income. We want you to use this. And we're like, well, okay, we'll use that. We also verified assets. Borrower had $80,000. So we were going to be approved eligible all day long. Just use your calculation and move on. Goes back and forth. Well, because the ratio was higher, then they still wanted to recourse. There was a credit supplement in the file. They were still counting every single debt against the borrower. The ratio was actually below what it had been, what they had been running at. And they're like fighting us tooth and nail. And like, once it hit the third time, I jump into it. I'm like, let me talk to your underwriter. But it's just like that waste of time that you have to pull resources to defend what the underwriter, and in many cases had even gone through QC. So we had an underwriter that said, this is the approval, QC reviews it, agrees with the underwriter and pre-close. Then it comes back, and then you almost feel like you're arguing with someone who's new to the industry. And it doesn't seem to be a lot of bend. So I don't mind having reviews, but make them worth, show me that I have something wrong so that I can put together an action plan to make it better if I see a trend. But there's no trend there. It seems to be a lot of just paper shuffling back and forth, and ultimately there's no recourse, no repurchase. But it's taking a tremendous amount of time because it scares everyone, right? You see the email come across and you're like, what did we do? What did we do? And it's like a false alarm. And then people get desensitized to those. So then they're not doing as thorough of a job as they generally would to fight it. And it's just back and forth, back and forth. We do have a lot of state audits going on right now. But I think that might just be due to the timing of when our licensing, when we initially got our license. So we're like hitting the 2 and 4 year mark on a lot of those. So I think that just they're happening to hit all at once, but not seeing really any findings coming back out of those. So it's mostly the Freddie stuff, but we don't do a ton. Like we're 20% Govy loans. So you would expect that our conventional stuff that we were seeing, but we're just seeing a higher percentage from Freddie than Fannie.
Yeah, we heard a lot from some of our lender members, specifically on the IMB side, that they have seen a lot of repurchase requests begin to flow across their desk. And I don't know if that's, I guess, is it because people now have time to look at them, or, is it time, or do they think that they're seeing a lesser quality somewhere along the line? But we would love to hear from you, your member benefits advocate, for those lenders that are on the phone. If you're having a number of those, I think we'll be planning some time to talk about how best to tackle those, because people haven't, really had a lot of those land across their desk in the last couple of years. And it kind of seems to be like there's a little bit of a trend there with that happening.
Yeah, I'm starting to see people hit where we didn't have issues with collateral for so long. Now we're starting to see more questions on collateral than we've seen for a while too.
Yeah. Yeah. And I suppose with things having escalated, that should, in the last couple of years, that maybe is expected a little bit, but yeah. So we've got just 1 minute left. LOs that have been LOs just for the last couple of years. We heard a lot about people haven't had to sell. What are you doing related to training? And some of those types of things. Tell us what your feelings are related to LO training and selling really when you have to sell a different way in the current environment and the environment that we're probably going into.
Well, we obviously take a very aggressive approach on education in general. So we have been fortunate enough, our head of learning and development created N&B University Sales Institute, and we started our first session back in September. But now we're seeing that we can relay some of that. We have a script diversity. So what do you say in this scenario? So that we can, even loan officers who are already licensed, it could be very beneficial to them. And I do think that the Mortgage Collaborative is doing a good job in moving the right direction with the addition of Stacy and bringing a university, mortgage university, to the TMC to help its member benefits is definitely the right area. And I give a shout out to them and looking very much forward to helping them along the way so that other members can take advantage.
Yeah, we've just heard so much of people that, it's like, especially in our maybe smaller lender member group, the ability to pay for some of the services out there for training that are out there, just so cost prohibitive. So Stacy's on the call with us today. I know she appreciates the shout out that you gave her related to our new learning and development platform that's being created. And we'll love to share that out with all the rest of you who have been on the call with us today as soon as we have information to share, and hope that you will join us. So I can't believe it. We're at the end of our half an hour already. That always goes by so quickly. So Jodi, thank you so much as always for helping us out and sharing your knowledge with everybody within the network. Everyone else who's on, have a fantastic day today. Come back next Tuesday at the same time to see Rich, and you'll have to ask him some questions about his vacay and how much fun he had. So look forward to seeing all of you. Thank you so much for joining us.
Awesome. Thank you, Faith. You did your best, Rich Swerbinsky.
Thanks.